following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp, brought to you by Sogo Trade, an extraordinary value in online trading. Why pay more for the same trade when Sogo Trade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp. That rockin' tune always puts me in the mood for some options education. My name is Mark Longo from the OptionsInsider.com, as well as from a little thing we hear in these old parts like to call the Options Insider Radio Network. And we're very pleased to have you join us today for this very special episode of Blossom, a.k.a. this very special episode of Options Bootcamp. Joining me for our year-end spectacular, I have not one but two partners in crime joining me on the show today, starting off with the man beaming in all the way from the far, far East Coast, where they are experiencing quite the blizzard, I hear, these days right now, or perhaps are about to any minute now. He is John Critchley. You may know him and love him as the Options Major Domo over there at SogoTrade.com. John, welcome back to the program, sir.
Hi, Mark. Hi, Dan. Glad to be back. It was a great year for the boot camp, and we, of course, appreciate all the positive responses we got from you, the listeners, and from all our Sogo Trade customers. And yes, we have a little snow in New York, but I think it's not as cold as Chicago, so I think I'll take the snow over the sub-freezing weather that you guys
yeah, everyone, the nation was treated to it last night. Of course, we are recording this in early December right after the big Monday Night Football Bears game, and it was about, I think, -4 with the wind chill. So I read this is unusual for us here. The last couple of winters, it's been really kind of mild. So to have, they said this was actually the fastest it's gotten to below zero in Chicago, I think, in about 18 years. So all of a sudden, maybe we're catching up for the last 2 years where it was 70 degrees in February and March and stuff. So maybe we're getting the teeth of that now. Hopefully not. And joining us from the far south suburbs, where it is also frozen and chilly, the man with the black cat, a.k.a. Mr. Dan Passarelli, the founder and CEO of Market Taker Mentoring. Dan, welcome back to the show, sir.
Hello, gentlemen. Hello, studio audience. How's everyone today? I'm ready for some boot camping today. How about you guys?
I'm excited. And, of course, our listeners may not know, this show is recorded before a live studio audience, so all of that boo and hissing you hear in the background and the throwing of vegetables and fruit, it's from all of the listeners we have gathered here in the listening audience. We're like a sitcom from the 80s, recorded in front of a live studio audience. But we did chat going into this, because we were recording this in early December, and we thought, what's a perfect kind of, these are our final two episodes for the year. What can we really sit down and talk about that would be interesting to a lot of our listeners? And we thought, what better thing to do than to really encapsulate the year that was in boot camp? Because we've really run the gamut here on this show, starting off back in January. This show, of course, has been running for a while, but we really kind of dove into a new gear back in January and hit on so many great, fantastic educational topics here and broke them down for you, the retail options trader. So we thought, what better thing to do in one of our final shows here for the year is kind of do a boot camp year in review and hit on all those salient and really, really important topics for you, the basic retail options trader. So whether you've been listening to us this whole time or whether this is your first show, and by the way, if this is your first show, then by all means, go back and listen to all the archives because you'll get all this stuff in a lot more detail. We're going to do a nice run through right now, though. So without further ado, it's time to dive right on into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in, prepare to learn. Yes, sir.
Always feels like the 4th of July whenever we roll on into the basic training segment. So festive, so patriotic, even though we are in the teeth of winter here in scenic and sunny Chicago. And so we thought, let's start off with this year in review, and what better concept to really kick it off with than the one we really kind of started the year with, and one of the really most important topics that underpins everything else we talk about here on this show. Those are, of course, the critical risk metrics, risk variables that we use to really analyze and measure our position risk in the options market. Of course, I'm talking about the Greeks, and who better to really summarize those for us today than the man who quite literally wrote the book on Greeks, even though he's not Greek. That's surprising, but good old Mr. Dan Passarelli. Take it away, Mr. P.
I was just sitting here before we got together to record the show. I was just sitting here working on a class, and I was talking about the Greeks. And let me just kind of lay out the premise of why they're important. First, the idea is when you trade, you probably don't hold your positions until expiration. I mean, at some point, the risk reward's no longer worth it, and you take the money and run, or you get out while the getting's good and take a small loss before it becomes a big one. Most people don't hold their positions until expiration. So if you want to understand the risk and reward, looking at a P&L diagram doesn't really help you because those are really only valid at expiration, right? So we need to have a way to understand the risks and the forces at play that make us money or lose us money with our positions, and those are the Greeks. They're simple metrics to help us understand when our options make or lose money. How is that happening? Why is that happening? What factors are contributing to that? So there's delta that measures directional sensitivity, theta that measures the sensitivity to time passing, vega that measures the sensitivity to implied volatility changing, and then we have a couple others, gamma, which measures the change of your delta, and rho that measures the change of your interest rate. And they're all really important, especially those first three. And so that is important review for everyone.
And do you subscribe to that theory that I've espoused on the show many times about how retail tends to focus more on delta and the professionals tend to focus more on vega or volatility, even though they both should really look at all of them?
Yes, yeah, I definitely see that even with my own students. Well, my new students. I fix them up when they come to me.
So a lot of you guys listening to this show right now are probably looking at the options market more from a delta/directional perspective, and that's really the point of entree for a lot of new options traders. But once you start listening to a show like this, once you start putting on a few trades in your own account, you start to become a little bit more familiar with the product. You start to embrace the full gamut of Greeks, and you start to realize what they all can bring to the table and what you really need to understand from all of them to really effectively manage your basic positions. Now, talking about basic positions, we're going to skip the what's a call, what's a put stuff because we assume if you're listening to this, you at least know that much, and you can, of course, check that out on our earlier episodes because we just don't have time to get into every single thing we've covered on the show over the past year. So we're going to dive right into some of the basic positions a lot of you guys like to use. And when you first come into the options market, it really boils down into two camps, and it really kind of stays that way throughout your time in the options market, there seem to be two ideological camps in the world of options. The buying premium camp, or the buying options camp, and the selling premium camp, or the selling options camp. A lot of people tend to generalize them as more the pros tend to fall into the selling and more the retail tends to fall into the buying, but that's really kind of been blown out of the water in the past decade or so. The two camps have really merged, and pros do both, retail does both. And there really is no right position for any one person to adopt. It really depends on what you want to do and what your trading style. So we're going to run through both of those right now, kind of some of the pros and cons. We'll start off with, I think, what still remains the opening trade for a lot of new options traders. That is, of course, coming in, you see a stock you like, you're bullish on it, you want to speculate on it from a bullish capacity, so you go in and you buy a call, usually a typically out-of-the-money call. And that is the trade everyone makes. And that is essentially a long premium trade, a buying premium trade. Of course, when you're buying options, you have to be cognizant of the Greeks like Dan just talked about, including delta, which is, of course, your directional exposure, how much your option is going to change with each dollar movement of the underlying. So you have to be cognizant of that and how your option is going to perform. But, of course, as Dan touched on, theta, time decay, is a big issue for option buyers. Because at the end of the day, options have an expiration date. So you have to be right within a certain period of time. And that adds an element of risk, an element of tension to a lot of new options traders saying, wow, I'm used to trading stock. I'm not used to having this ticking clock on my options position. Now, along with that ticking clock comes this element of time decay. Your option is going to lose a little bit of its value every day as it approaches expiration. So if you're trading that option, you have to have some sort of plan that's going to account for that and make up for that and hopefully supersede that in terms of profiting overall on that net trade. So if you're just buying a call, for example, you'll need that underlying to really dramatically move in order to offset all of the decay you're going to experience with that underlying. Either that or perhaps have volatility just increase to a dramatic level to help offset a lot of that decay as well. Or perhaps, best case scenario, both of those occurring at the same time to really make that call a home run. But the decay, that ticking time clock for options, or as some people like to say, options die a little bit every day, is one of the first factors you have to really take into account when you're buying options and putting on long premium type trades. Now, John, I know a lot of the clients over there at Sogo, you guys actually fall into a unique niche in brokerage firms. A lot of the retail firms we work with and talk to, a lot of their clientele like to blast out options. They're hitting bids all day long. They like to be short premium. But your clientele over at Sogo actually seems to be a little bit the opposite. They like to come in and buy options. So I'm sure you deal with a lot of questions on the buying premium side of the fence on a regular basis. So why don't you walk our listeners here through some of your basic pros and cons of buying premium?
Yeah, thanks, Mark. So we have the majority of our customers, Sogo Trade, tend to be, and I think most retail on the buying premium side of the equation. There's the thing that I like about buying premium is that, as Mark and Dan stated, that there's limited risk. There's potential for large profits, but how much you're going to lose. I mean, there's a predefined number. It's relatively stress free. The downside is, as Mark said, they're a wasting asset. So I always tell customers, be prepared to lose your initial outlay. If I tell them, allocate a certain predefined portion of your trading account to some speculative plays to buying premium, and know the risk or chances of the option being in the money, whatever the delta might be, and every so often take a shot, buy some premium. But just remember that they are a wasting asset, and you may lose your money. But set aside maybe 5 or 10%, to buying, the buying premium, and see what happens. But don't get too. We get customers sometimes that get a little reckless and go crazy and buy too much, and then they lose all their money. So just be in control when you buy premium.
Yeah, there is that tendency with a lot of retail to really want to swing for the fences and hit that home run. They'll see that perhaps the at-the-money option is $5, but hey, this out-of-the-money call, this 10 delta call is 30 cents. And so now I can buy 50 or 100 of these as opposed to 5 of the at-the-money calls. So let's go swing for the fences. And, of course, We touched on this many times on the show in the past. A lot of brokerage firms, like including yours there, John, are doing a lot of efforts, including shows like this, to educate the retail audience about the dangers of doing exactly that, because then you load up, swing for the fences, you lose everything, they become disenchanted with options, and they take their ball and go home. They go back to mutual funds and stocks, and they say, wow, those options things are really risky and dangerous, and I can't believe I ever traded those. And that's exactly the type of impression we want to avoid here on this show, which is why we walk you through all of these various scenarios in such exacting detail. Now, of course, the flip side of the coin of buying premium is, of course, selling premium. This can become very attractive to a lot of retail once they start trading options a little bit. Maybe they get burnt buying some premium, buying options. They say, wait a minute, this time decay thing really can come back to bite you. This is difficult to overcome. Now, if I start selling options, now time has gone from being my enemy. Suddenly, time is my friend. Time is my ally. Time is what is making me money. I am collecting money every day that these options die a little bit. And so that becomes attractive for a lot of retail options traders. Sometimes they'll put it in a covered call position. Sometimes they'll come out naked writing these options. So that's where it really starts to become both attractive when they see the benefits of it, which exactly like we said, collecting theta is a very attractive thing. People will start to say, wait a minute, you don't make money buying insurance, you make money selling insurance. So why should I buy insurance? I should be selling insurance. And that's both an attractive mindset and indeed a dangerous one as well. You know, all of us here on this show have seen a lot of experienced professionals go heavy to the dark side of writing premium and pretty much only trade short premium and collect decay all day. And that can be a very dangerous scenario for a lot of the reasons we described. Of course, as Dan hit on the Greeks earlier, there is that relationship between theta and gamma. They are essentially inverse Greeks of each other. So if you have a lot of theta, you're also going to have a lot of gamma. And if you're short theta, if you're short gamma, you're going to be, if you're collecting theta, you're going to be short gamma, which means that could be a dangerous thing because remember, gamma is the rate of your change of delta. So you have a lot of short gamma, now all of a sudden stocks dropping, you're getting longer deltas at a very rapid rate. And anyone who can do basic math can quickly realize that's not exactly a profitable scenario. Same thing as you're rallying, you're getting shorter. So these are things you want to try to avoid, and that gamma can come back to bite you in the butt, particularly with so many people embracing the weeklies these days. We've seen weeklies really become this just premium selling tool, even though they were designed as completely the opposite. They were designed to hedge very near-term risk. For whatever reason, the audience has embraced them as premium selling, premium harvesting type tools. So it's a great use case. It's certainly a great strategy if you do it in a risk-defined way, but for whatever reason, so many people tend to go overboard, which is why we take very, very tentative steps on this show, recommending any sort of short premium type trades that aren't risk defined, because it can be very easy and very tempting to start really adding on a lot more risk than you necessarily need. Now, Dan, you're dealing day to day with a lot of these retail clientele coming to you, and I'm guessing you spend a significant amount of your time on any given day walking people back a little bit from the abyss and say, wait a minute, you don't want to just do nothing but sell all day. There are some reasons to buy or perhaps put on some spreads. So walk us through what that discussion is like over there at MTM.
Trading is all about volatility, really. There are clearly certain advantages to selling, as you just pointed out, Mark. But there's advantages to buying as well. You know, you have that unlimited profit potential, and unlimited is a little bit abstract and not realistic, but there is significantly higher profit potential relative to your loss. Limited loss, leverage profits. So you kind of need to know when to hold them and know when to write them. You know what I mean? And when you do that, there's a couple of different criteria that you need to take into account. One, of course, is what is the volatility that I expect for this stock? I mean, the literal volatility, the historical volatility or statistical volatility. If I think a stock's really going to move a lot, I don't want to sell options on it. I want to buy options. And that's just kind of common sense. If there's a stock that I think is going to have very, very low volatility and not going to move a lot, the only way to make money is to sell options on it. You can't buy the stock, you can't buy calls, can't buy puts, can't buy straddles. And that's common sense as well. But then you also have the pricing nuance, the implied volatility factor. And it's kind of apt to talk about this since this is a year in review show, because we've talked about this a lot on a lot of the shows we've had this year. Implied volatility, the other volatility, basically tells you whether options are cheap or expensive. That's kind of the best, most straightforward lay definition. Implied volatility tells you if options are cheap or expensive. When something's expensive, when anything's expensive, you want to sell it. When something's cheap, anything, you want to buy it. It works the same way with options. So when you see that really, overpriced volatility, and there's a whole lot of education that can be done behind that, but when you see overpriced volatility, you're more inclined to sell options. And when you see underpriced volatility, you're more inclined to buy options.
The one thing I wanted to mention, I said this before, and it's not my saying, but, I'm a big believer in protective puts. What is that? That means buying puts to hedge and protect your portfolio. And, it's been said that it's better to have insurance before your house burns down than rather try to buy it as it's burning down. This can be also said about purchasing insurance or put options to hedge a portfolio. And what I like to recommend to customers is that the first trade that most customers will do if they don't buy options, they'll do a covered call. So if you're going to do a covered call, you're long the underlying, you're still adding the money call, well, you know what? It's a covered call, and that covered gives the perception that you're protected, but you're not. So what we do is we'll have the covered call on, and we'll buy a protective put, okay? And that's what they call a zero-cost collar, and that way you're protected. And there was a study that we've mentioned in the past, done 4 or 5 years ago, that showed over a 10-year period that if you use this strategy, okay, you had the same return as a long-only strategy, okay, but you reduce your risk by 65%. So the point of me bringing this up is that, you can't just buy premium. You can't just sell premium. You have to be very flexible, and one of the ways you can hedge yourself is by doing these zero-cost collars. Great way to hedge yourself, collect a little premium, and sleep at night.
Good point, John. Jumping right to the collars, I like that because that is indeed a very effective tool and strategy for a lot of our listeners. Of course, the collar having those two components John just outlined. The typical covered call component where you're long XYZ stock and you decide, hey, I don't mind selling it at this level above the at-the-money strike. I'm going to sell an option right there, collect a little bit of extra money. If the stock goes sideways or kind of just goes a little bit up, I collect that money and I still get my appreciation. If stock drops, I have a little bit, let me emphasize, cushion in the bank for that, and you could keep writing that position over and over again. A covered call, very attractive for a lot of our listeners. Of course, John just outlined the protective put as well, which is, of course, your long underlying. You buy this put, you say XYZ is trading 100, you buy the 95 strike put for $1. You've effectively drawn that line in the sand at $94, this far and no further. The very important strategy for a lot of people in this market environment right now. We're, of course, recording this here in December of 2013. Market has had an extended, prolonged rally. A lot of people, our email, our phone is ringing off the hook here with people, retail, financial advisors, asset managers, what have you, saying, hey, I have a lot of gains. What can I do to lock some of these gains in without really selling and protect some of these gains without really selling the underlying in case there is more upside potential ahead? An ideal use case for options, and that is where the protective put comes in. Of course, you combine those two, you get what John just outlined, the zero-cost collar. So 3 very great strategies for you, the basic retail options trader, to implement in your own portfolios. If you want more detail on either of those, of course, surf on over to theoptionsinsider.com. Click on the Options Insider Radio Network tab. Click on the, of course, Options Bootcamp tab, and you can find all the archived episodes of this program there where we go into all of those strategies in much more detail. Of course, you can find it all on Stitcher or iTunes or wherever else you get your podcast of choice as well. It's all there in our archives for you guys to really hit in much more detail. Now, one of the other great tools that we've discussed on this show in the past is for a lot of you retail guys coming to us, listening to this show, coming from the stock world, trying to learn ways to incorporate and work options into your stock trading. One of the great tools that I think could be effective for a lot of you guys out there is, of course, getting rid of your stock trading and replacing it with options. That gets to the stock replacement strategy. A very, very effective tool, let's say, particularly in a lot of the names a lot of you retail guys like to trade the expensive ones, the Apples, the Amazons, the Pricelines, the Googles, the $300,000, $400,000, $500,000 type names out there that get very expensive, and laying out the cash in your account to buy 100 shares or a round lot of all those stocks is prohibitively expensive. Remember, the best you can do from a margin perspective when you're talking about the underlying is, of course, 50%. So you're going to pay at least half, if not more, of what you're buying if they're in full of stock. And that's a lot for a lot of people to tie up in their accounts. Now, we've talked before, and again, check out the archives of this episode of this show for a full rundown of the stock replacement strategy. But in a nutshell, we've talked before about going out and buying a little bit longer term, maybe 6 months, maybe a little bit longer, maybe a year, depending on what you really want to accomplish with this position, what your time frame is, and looking at an in-the-money call, typically something with 70 plus delta, maybe 80, maybe even 90, depends how meaty you really want to get. A position that closely approximates owning the underlying itself from a delta perspective and everything else. And then you can use that and buy that instead of buying the stock. And now you've essentially created a position that, again, has a substantial amount of the delta or directional exposure that the underlying does, but also includes all the other fun things that options offer. Like, of course, there's a volatility component now. So if the underlying drops, of course, you're going to have a little bit of that volatility seeping in, and you're just going to offset how much you lose. You're going to lose money at a slower rate than the underlying dropping. Of course, you have a delta. It's not one. You're not buying stock. So if you bought stock, the stock drops $1, you're going to lose $1. You have a delta. So if your delta is 70, stock drops $1, you're going to lose 70 cents. As the underlying keeps dropping, which indeed is the worst case scenario in any sort of long stock position, then that delta is going to decrease. You're going to keep losing money at a slower rate. So that's, of course, an attractive thing. And then, of course, you have the leverage component of options. You could buy that position and put it on for 6 months or a year or whatever your time frame is for usually a significant discount to what you actually would have bought the stock for. Could be 25% of the overall stock position. Could be 10%. Could be a significant discount off what you would have outlaid to buy the stock outright. So the stock replacement strategy, a fantastic tool for a lot of you listeners. It can be used in a lot of great ways. Of course, stock replacement by itself is attractive. You take that stock replacement and now you incorporate what we just talked about, the covered call strategy, where you're buying these longer term deep in the money calls, let's say 1 year out, and then you're writing nearer term calls 1 month, perhaps even weekly. Now you've created a fantastic covered call position where you don't have all that capital tied up in buying the stock. So it's very attractive for all the reasons we just outlined. Again, we also have a great discussion about that in more detail on the program. So stock replacement strategy in and of itself, very attractive. Mix it up with a covered call, it becomes even more attractive for a lot of our listeners. Speaking of attractive, we touched on at the top of the show, buying a call, buying a put. These are all single leg option strategies, essentially. But when the rubber really meets the road in the options world, it's when you start learning how to spread. Spreads are really what separate the pros from the average traders in the options world. It also what generally separates options from most other instruments. It really allows you to create almost a limitless number of combinations of positions and really construct whatever you want using the options to approximate any other position that your heart desires. Once you start really grasping and getting a handle on spreads, the sky really is the limit to what you can do with options. And the way most people get started with spreads is they talked before about coming in, learning about options. They buy their simple out-of-the-money call, and they probably lose money on that trade because that's a low probability trade. And then they say, wait a minute, what if I instead dive into the world of the basic vertical spread? And I know, Mr. Passarelli, you're a big fan of vertical spreads in all forms, in particular that basic vertical spread. So walk our listeners through some of the pros and cons of, let's say, a simple vertical call spread, for example.
Yeah, there's a lot of strengths to a vertical call spread. Basically, it's safety and leverage all in one package. It's just often a much better way to trade something you'd otherwise trade just by simply buying a call or something. So when you buy a vertical call spread, aka bull call spread, debit call spread, what you do is you buy a call just like you otherwise would if you were to speculate on a stock rising. But at the same time you buy that call, you sell a higher strike call. Now, why this is beneficial to you is because when you sell that other call, what you do is you offset some of your risk. You pay less, and therefore you have less capital at risk. Now, depending on how high the stock rises, you might make a higher percentage profit, or you might give up some upside. So there's a little bit of a trade-off. If the stock rises up to the strike price, you're going to make more actual money and a much higher percentage by having done the vertical call spread, the bull call spread. If the stock rises up through the short strike price, you're kind of topped out. You reach a maximum profit potential and you leave a little something on the table. So, it's like any other option strategy. The reason there's so many of them is because they're each appropriate for a specific market situation. Vertical call spread, the bull call spread, if you think that a stock is going to make a move up to a point, but not a big gigantic move, bull call spread's better. If you think that a stock can really run and it's going to break out and you don't want to limit your profit potential, just go and buy a call.
Yes, many, many different use cases for many different positions here in the options world. That's why we love it. That's why we can fill so many shows on this network with such in-depth analysis, because there really is no limit to what you can do with options once you start tinkering and adding legs. It makes it fun. Of course, that basic vertical spread, a great way to migrate your liquidity from these mostly worthless out-of-the-money options down towards a meteor strike, perhaps the at-the-money, perhaps even an in-the-money, and make that a more cost-effective prospect by then selling the AKA worthless or somewhat worthless option and using that to offset some of the price of that meteor option. Give yourself a higher probability of success at a lower cost. Always an attractive prospect for a lot of our listeners. Now, there's a lot you can do. Vertical spreads are just a start. Of course, when we're talking about vertical spreads, there's a lot you can do even within that realm before we get to other types of spreads. And then once people start doing those simple vertical spreads, they buy an at-the-money call, they sell an out-of-the-money call, and they say, wow, this is really attractive. I got that at-the-money call for a lot less. Then they start getting into some other ways. They start learning, hey, what if I buy one at-the-money call? It's say the at-the-money call is $4. I sold the out-of-the-money call for $1. That spread cost me $3. If now I sell 2 of those out-of-money calls, that spread's only going to cost me $2. And you can see where the logic goes from there. It's a very attractive type of trading. It's called the ratio spread. This comes in many different flavors. It can be 1x2, 1x3, whatever strategy you prefer. It's attractive for the reason I just described. It's a way to reduce your net outlay of your trade. Of course, you can imagine once you start rallying in the underlying, you start getting closer to that strike where you're short, then from a risk perspective, gets to be a little bit less attractive, especially if that ratio is pretty steep. Most brokers are probably, like a guy like John's going to give you a call if you start trying to go 1x5 or 1x6 or something in your account and you don't have a lot of capital there to back it up. Remember, there is no free lunch in the world of options. We've hit on margin many times in the show. John's done a great job of really running through that. And, the more options you're selling, if you do a vertical spread 1x1, you're essentially flat. You're covered. If you do a vertical spread now on a ratio 1x2, now you're essentially naked short a leg to the upside. So a broker like John is going to hold some margin in reserve to cover that. You start doing 1x3, 1x4, you're going to tie up a lot of capital. So people think this is a great free lunch in the options market, a way to get a vertical spread, way to get a meaty option for a great low price. And it does reduce that price, but you're also going to have an opportunity cost that a lot of listeners don't really, and a lot of traders really don't really factor in when they're putting on these types of crazy ratio spreads. So the ratio spread, very attractive, but of course it has some risk factors as well. Now, Dan, I'm sure you're probably more of a fan from a risk perspective of flipping that around a little bit and taking, I guess, what you can call the reverse ratio spread, a lot of different names for it out there, and actually taking advantage of some of that decay factor and some of that offsetting premium and putting it to work in a different strategy. Is that one of your favorites out there?
Yeah, I mean, the best thing about options is you can be really, really creative. One time I was down on the trading floor, trading one of these pits, and there was a new guy who started in the pit. He wasn't actually a trader. He was like a clerk, basically. And he was explaining this fantastic strategy that he came up with. He just did all this research and studying, and he came up with this new thing. And basically what it was you sell an in-the-money call and buy a bunch of out-of-the-money calls cash neutral. And it was brilliant. He thought of this all by himself. And I just listened to him. I'm like, yeah, this kind of sounds a lot like a backspread to me. And he's like, oh, yeah, I guess it is. So ratio spreads of various sorts, whether you're buying more than you're selling or selling more than you're buying, they have a lot of power. You got to be careful. You really got to know the risks. But like I said, for the last point, under the right set of circumstances, any strategy can be the perfect one to use.
Yes, and a lot of listeners get hung up on terminology. You just mentioned backspread. I call it a reverse ratio spread. Both two different terms for the same thing, essentially being net long more contracts than you're short in these types of ratios. Flip it around, they call it a front spread, where that's a more traditional ratio. You're short more than you're long. Don't ask me where the terms front and back spread came from. I have no idea. I don't know if anyone really does at this point. It's kind of lost in the mists of the options market. Kind of arcane terminology, really, but it still pops up every now and then. We see some listeners getting confused by that. So if you're confused by the terminology, we've actually added a great options FAQ section on the optionsinsider.com, so you can look up a lot of this stuff there. And we'll be adding more all the time. So if you have a question of something like that or a term you'd like to see defined in there, let us know. We'll help you out. Now, there's different ways you can utilize these ratios and these vertical spreads, like we just outlined a couple of great examples for you. The front spread and the back spread, or the ratio and the reverse ratio spread, whatever you want to call them. Two great strategies to utilize in different scenarios. There's other ways you can utilize verticals, though, and those are also in conjunction with stock. And it's a great way when perhaps your stock position is taking a little bit of a beating to use verticals to help speed up the repair a little bit. Now, John, I know you're a big fan over there at Sogo of walking a lot of your clients through this stock repair strategy. So why don't you walk our listeners through that exact strategy right now?
Sure, Mark. Most, if not all, option customers are equity traders first, and they come to options being very equity-centric. And the stock repair strategy is maybe my favorite strategy for these customers. I get the call all the time, John, what do I do? I have stock that I own that I love. It's gone against me. I don't want to sell. What do I do? Well, the one strategy is the hold and pray strategy, which requires you just to hold on to your equity position and see if it retraces. That's not really a great strategy, in my opinion. There's also a worse strategy, which is a double up strategy, where you average down, you buy more. That's the worst strategy you can do. It almost always fails. The third strategy, which I love, is the stock repair, which basically is if you bought a stock at $100 and now the stock falls to $90. Well, a stock repair strategy would be buying buying one call at $90 and selling two calls of the 95 strike. Okay, and what that enables you to do, and all you need to do is go to an option chain and look at the numbers. You try to do it cash neutral or money outlay neutral, and if you bought the stock at 100, now it goes to 90, and you put that spread on. What happens is the stock goes to 95, then all of a sudden you're broken even on your overall position. So what it allows you to do is that allows you to, in a cost-neutral way, to lower your cost of owning the stock. And it's one of the best strategies, and we did a podcast on it, and I highly recommend it to all customers who own equity, don't want to sell it, and I tell them, don't double up, don't just keep praying for the stock to go higher. Try the strategy, and the worst case happens, both your options that you bought and sold, they expire worthless, and you're not worse off. So customers should look at that strategy, educate themselves, and give it a try.
A great strategy, like John said. We do have a whole episode on that in our archives. Look for the stock repair strategy episode, and you can hear all of that in a lot more detail. Now, of course, there are some other spread positions, I guess you can call them mega spreads. They're very attractive and also very problematic for a lot of new retail options traders. In fact, still to this day, one of the big scams that preys upon new retail options traders is that old pitch of use options to make money in any market environment. No matter which way the market goes, you will make money using options. Take my course for $2,000 or $5,000 or whatever amount of money it is, and you too can learn the mystical genius strategy that I have to make money no matter where the market goes. And of course, to a newcomer and options novice, that sounds like magic, and it sounds too good to be true. And of course it is, listeners, because that pitch is centered around really this next spread. It is centered around the straddle. And it's for years, this has been kind of the sucker ploy for retail. And because on the surface, what they're saying is correct. The straddle, of course, being that combination of buying a call and buying a put on the same strike. XYZ is trading 100. You're not sure where it's going to go. The XYZ call is trading $5. XYZ 100 put trading $5. You buy them both for $10, and now no matter where the underlying goes, there you have it. You make money in either direction. But of course, even in that example I just outlined, you just spent $10 or 10% roughly of what that underlying is worth. And that really gets to the heart and the meat of the problem with straddles, is that they're very expensive. You're not buying one option on the strike, you're buying two. So you're essentially doubling down and buying twice as much of the premium and all the time decay and everything else that we talked about on the top of the show. So if a traditional single leg strategy is going to suffer from time decay, of course, two legs is going to suffer from time decay even more so. And so that's really the crucial problem. People come in and say, wow, straddles, this is a great way to make money buying them. But of course, you have that time decay factor, and these straddles are going to erode call and put, both eroding at the same time. So that means you as a trader have to do a lot of work to really overcome that decay and make some sort of strategy that can offset that in a reliable fashion. And that is really the danger. And that's what a lot of those courses don't teach you, which is why they kind of bring you in, charge you a lot of money up front, then send you out to lose all your money. Straddles are attractive on the surface, but once you learn really the mechanics underneath them, it becomes a difficult road to hoe profitably. You really need a lot more sophisticated tools in your arsenal, including to be an account with the size and the margin treatment to be able to scalp gamma, aka sell the underlying, as that straddle moves around to really make money off those positions in the long term and survive the decay that you're paying in the near term. And unfortunately, most retail just don't have those accounts. Of course, on the flip side, you can't just come out and sell straddles either. That's, of course, a very risky prospect as well. And it deals with a lot of intendant risks that are really, I think, for a lot of retail, extremely, extremely dangerous. That's a lot of short gamma. You're dealing with a lot of directional risk can build up against you with a very small movement in the underlying. Of course, not the counterpart, but perhaps a step back from the straddle, which is two at-the-money options, is the strangle, the flip side of that, if you will, where it gives you a little bit more distance from the at-the-money. It accomplishes somewhat of the same things, but it's, I won't say safer, but gives you a little bit more cushion for some movement in the underlying. Dan, why don't you walk our listeners through the pros and cons of the strangle?
Compared to the straddle, the strangle has just a couple of differences. Straddles, you buy a call and a put, same strike. Strangle, you buy a lower strike put and a higher strike call, typically both out of the money. And so the trader's laying out less capital. Arguably has less risk because you can lose less money. The profitability is kind of similar. I mean, if you were to hold the strangle until expiration, the break-evens would be a little bit farther apart. But if you're going to hold a strangle until expiration, it doesn't really matter because you're probably going to lose money anyway. They're not really designed for that. What they're designed for is when you think that a stock can have a pretty good move in a short period of time, then you buy a straddle or a strangle. For me, why would I choose a strangle over a straddle? Typically, it's strike proximity. Like if I'm looking for a volatility play and the stock is sitting right at a strike and the call delta and the put delta are both about 50, well, I'm going to do a straddle. But if the stock price is sitting smack dab between two strike prices, and if I do a straddle, I'm going to end up either being long or short deltas because the call delta and the put delta are not, the absolute values are not the same. Well, then I'm going to choose a strangle so that I can even out those deltas and have a more direction neutral, delta neutral volatility play.
Of course, that brings us to the next level, the next step, if you will, in the world of spreads. And those are, of course, the spreads with wings Again, another topic that we did an entire show on. Check the archives for more detail on those. But there's a huge variety of spreads with wings. You have your condors, your iron condors, your butterflies, your iron flies. But in the example we just laid out, the strangles and the straddles, you can put those two together and see some interesting use cases just for combining those two. Because we talked earlier about both the positives and the negatives of straddles and strangles, that they offer a little bit of profit no matter where the underlying goes, but they're expensive, a lot of decay. In the case of the straddle, particularly in the short straddle, there's a lot of risk. In the long straddle, there's a lot of decay. You're offsetting. But what if we combine those two scenarios? Now let's say we buy an at-the-money straddle, $5 for the call, $5 for the put, and then we turn around and we sell a strangle where the out-of-the-money call is $1 and the out-of-the-money put is $1. Now we took $2 off the price of that straddle, so now we knocked it down to $8, made it a little bit more manageable for us. That, of course, that combination of an at-the-money or wherever you want to do it, the combination of a straddle in the middle there with an out-of-the-money strangle, of course, being one of my favorite positions. It is the iron butterfly, and you can see just intuitively how those two positions work together very well. In the case of the long iron fly, where you're buying the guts, the strike in the middle there, and selling the wings, then you can see how that offsets a lot of your premium and the amount you're spending. Of course, it also limits the profit potential, so keep that in mind when you're constructing those positions. The flip side, if you're going to go out and sell straddles, then this is a great way to mitigate and limit the amount of risk you're actually going to incorporate. For example, if you sell that at-the-money straddle, again, for $10, you're going to collect $10, but maybe you pick those strikes. You pick those strikes $10 out and you pay $1 for each of them, so that once you start moving beyond your profit potential, then you can actually mitigate how much risk you're incurring in that position. So you can see just in combining those two very simple positions, the straddle and the strangle, to create that iron butterfly, some of the use cases you can put those two. Of course, there are quite a few. I think everyone and their mother, seems like every news service, every newsletter service, every brokerage firm, you name it, they're all really out there pumping the iron condor. I never really understood why people like condors versus flies. I guess because it gives you a little bit more cushion. It's not quite as scary as the iron fly is itself. So for the benefit of all those listeners out there who are just entranced, hypnotized by the iron condor, Dan, why don't you walk our listeners through the pros and cons of that position as well?
Yeah, it's just like anything else. There's kind of some trade-offs. Iron condor, it's basically two credit spreads at the same time, right? Call credit spread and put credit spread, both out of the money. And the obvious advantage, is that you're taking in two credits. And if the trade doesn't work out, you can only lose on one of those trades. So overall, there's kind of really a synergy, It's not like today I do a call credit spread and then on some other position I do a put credit spread, because there you take in two credits, but you can lose on both. Here you take in two credits, but you can only lose one way, and ideally you don't lose either way. So what you want to do with an iron condor is look for a stock that's trending. I like to look for stocks that are in pure horizontal channels, where you have a horizontal, not an upward or downwardly sloping, but a horizontal support line and a horizontal resistance line. And you see the stock hit support, hit resistance, hit support, hit resistance, and bounce around in that channel. Then what I like to do is I like to sell a call credit spread where the short strike of the call credit spread is at or above resistance, and the short strike is at or below support. And then you've kind of got some technical edge, if you will, because the market has proven in the past that it doesn't rise above resistance. So there's arguably some help for your call credit spread, something that makes that a more likely winner than just sort of the random walk. And you have that same conceptual help for your put credit spread, because if the stock tends to not fall below support and your short put strike is at or below support, then there's some technical help there. There's some support that props up that stock to help make your put spread a potential winner.
Indeed, and I can see certainly the attractiveness of having, if you're looking to sell some premium in a risk-mitigated fashion and you don't want to perhaps blast out an at-the-money straddle, which is involved in the iron fly, then of course the iron condor gives you a little bit of cushion. Flip side, if you don't want to spend all that money to buy an at-the-money straddle and then sell the wings, the iron condor, of course, gives you a little bit of cushion that way as well. So I could see why some people like. I can also see why some people call the iron condor or the iron fly for cowards. I'll leave that subjective judgment to you, the listener. But of course, since we're hitting on all these spreads in the same expiration month, all these vertical spreads, is important to touch on now that very important topic of volatility skew that really comes into play for all of these spreads that span multiple strikes in the same expiration month. So, Mr. Critchie, why don't you go ahead and give our listeners a quick rundown, an overview of that most important topic of volatility skew.
Yeah, I would love to, because we get this question all the time. You know, we have our customers that look at the option chain. They see that the lower strike prices, the at-the-money puts, 95% of the time have a higher volatility reading than the at-the-money options or the at-the-money calls. And this volatility smile exists for a few different reasons, and I'll quickly run through them. The first is because there's a real-life principle about the investing world. The vast majority of equity positions are long. This is driven by rules that govern pension funds, mutual funds, and the retail public basically always long the underlying. And when the long investor makes, two different trades normally, or a long equity investor, they'll either write covered calls, or they'll, as we mentioned earlier, and also we mentioned buying the protective puts. So what does that bring? It's supply and demand. The public has a desire to buy the puts, and in a supply and demand market-making world, that's going to drive the price of the puts up or the implied volatility up. And what do they want to do also? They want to sell out of the money calls. So guess what? The market makers lower the price of the calls. So you're going to see the skew. Now, why that's so important for myself and for our customers is that when you ever see, this is my favorite trade, when you ever see that volatility skew, bending or reversing, where the out of the money calls become, equal to or higher than the at the money or at the money options, that is usually a buy signal. That usually means that someone thinks they know something, and more likely than not, they're going to be right. So that's a big buy signal for me. So look at the option chain, look at the skew, and if you ever see it invert or reverse, then maybe if you take some of that speculative money, buy some out of the money calls.
Again, listeners, if you'd like more about that very, very important topic of volatility skew, check out our archives, in particular episode 32, where we dive into that topic of volatility skew, investment skew, where it comes from, what it means, all that great stuff in a lot more detail. Now, of course, we've hit on all these trades in the same expiration month, but not all your option trades are limited to the same month. No, not by a long shot. We like to expand our horizons beyond just 1 month, maybe front month and next month, maybe front month and 3 months, 6 months out, a year out, whatever your strategy requires. There's a spread for you out there. And of course, once you start doing these spreads beyond just the simple front month or same month type spreads, you're getting into what we like to call calendar spreads. And I'm trying to think, I don't think there was any other topic we discussed on the show this year that generated more listener mail, more questions, more comments. And I knew that going into this. This is, of course, a very, very, very challenging subject, particularly for a lot of basic retail options traders. It's a difficult concept to wrap your head around, the balance and trade-off of gamma versus theta that comes in a lot of these spreads, and gamma versus vol that comes in a lot of these spreads, and how you really make that trade-off in your head and how you handle and manage and adjust these things. It's a very, very sophisticated subject matter. Again, check out our archives for the full rundown. But of course, we started off with your simple, basic calendar spread, where you'll come in, you'll buy a 2-month out option, typically, let's say, an at-the-money call, and then you'll turn around and sell the 1 month out or the front month at-the-money call option as well. And you've created this nice little simple calendar spread where you're short the front month option, long the farther out option, collecting some decay for that near-term option, long some volatility in that farther off option. It's a very interesting type strategy, interesting type spread, particularly that underlying sits there through that expiration of that first short leg of the trade. Of course, there's a lot of different ways you can go from there. The simple, basic calendar, the at-the-money call spread, for example, is really just the starting point. There's a lot of ways you can go, including diagonals. And I know, Mr. Passarelli, over there at MTM, you spend the bulk of your time walking your clients and your mentees through a variety of different basic calendars, diagonals, all that fun stuff. So why don't you do the same here really quick here on the tail end of this year in review show and walk our listeners through a quick overview of your basic calendars and get into some fun with diagonals as well.
Basic calendars are not entirely basic. There's many uses for them, but the most basic use is as a simple income generation strategy where, like Mark was just talking about, you buy the long-term option, you sell a shorter-term option with the same strike price. The key to these strategies is theta, of course. The option you're selling has a higher theta than the option you're buying because it has less time until expiration. But the key to actually making money on these is to put them on for a volatility edge. You need to buy the option with the lower volatility and sell that shorter term option only if it has a higher volatility than the option you're buying. Otherwise, you might make money, but you're going to make less money than you should. And when you lose, you're going to lose more than you should. You're basically putting it on for what we call negative edge, for a statistical disadvantage. And as a trader, you never want to do that. And diagonals, conceptually the same thing. With a diagonal is a calendar spread, but it's two different strike prices. The typical way I teach my students how to do a diagonal is buy a longer term in the money call and sell a shorter term out of the money call, higher strike. And the idea there, just in simple terms, consider the long in the money, longer term call as a proxy for the underlying stock, and you basically trade it kind of like a covered call. It can be arguably a little better than a covered call because you have less risk, because buying that in the money call as a proxy for the underlying stock gives you limited loss potential. So if the market happens to crash tomorrow, you're not going to lose as much as you would if you actually did do a covered call.
Again, the same strategy I outlined earlier in the show with the stock replacement strategy and using that in conjunction with a covered call strategy. If you're doing that, if you're buying that long-term in-the-money call and writing front-month covered calls against it, you've essentially set up a diagonal spread position, listeners, whether you want to admit to it or not. So that shows you just how basic these things can be and how simple and easy to implement they can be in your own portfolios. Of course, Dan talked about using the calendars to offset the decay of these options. We're seeing a lot of interesting use cases these days with the weeklies where people are coming in. They've, of course, listed the full strip of weeklies for a single month now. So a lot of people coming in, let's say, buying a 1 month or 3 week out weekly and then selling a 1 or 2 week out weekly against it and doing a lot of interesting calendars that way to help finance the cost of some of their longer term speculations or protective puts or whatever they have putting on. Finance the cost of their longer-term hedges or speculative positions or whatever they have going on out there in the weeklies. Unfortunately, we could keep going. We hit on so many topics this year, but unfortunately, we have to wrap up here. We didn't have time to get to, of course, VIX or synthetics or margin, a lot of other great in-depth topics. If you want to hear more on that, of course, check out the archives over there at theoptionsinsider.com, or you can find them at iTunes, Stitcher, Aha Mobile, whatever the case may be. And before we go, let me check in with each of my cohorts, my partners in crime, to see what they have cooking in their respective necks of the woods. Starting off with you, John. What's coming up in the land of SogoTrade.com?
We are beta testing our new platform, an application-based platform called Sogo Elite. And I think I had mentioned this in the past, another elite platform. But it should be launching the early part of next year. It'll have advanced charting, option capability, and it's a fancier platform. We're still tweaking our new optimizer for the margin. It looks pretty good. And as always, you can check us out on Twitter at Sogo Trade Option, and of course on Facebook.
Kick the tires over there at SogoTrade.com. I think you're going to like what you find, particularly if you're looking to save some money on commissions. SogoTrade, certainly a great choice for that. And Mr. Passarelli, another one who's jumped into the elite fray with your Elite MTM forum. How's that going? What else is cooking over there in the land of MTM?
The MTM Elite Trader community is going awesome. I can't say enough good things about it. We're really, really proud of what we created. Basically, Facebook for traders, you want a 2-week trial of it, go to markettaker.com/2 for 2. That's the number 2, the word FOR and the number 2 again. It's $2 for 2 weeks. Try it out for yourself. It's really, really cool. It's like Facebook, but just for traders.
I love it. Check it out, listeners, and you could enjoy the elite experience on both platforms, on SogoTrade.com and on the Market Taker Mentoring Elite community. A lot of great elite stuff cooking over there. And on behalf of John and Dan, and of course myself, I want to thank all of you guys out there in the listening audience for downloading and streaming and subscribing, and for writing in such great questions throughout the year. You guys have been great. And we'll see you next time right here on Options Bootcamp.
Options Bootcamp is brought to you by SogoTrade, an extraordinary value in online trading. Why pay more for the same trade when SogoTrade can deliver for less? Options commissions are just $5 per ticket and 50 cents per contract, and just $3 for stock and ETF trades. Open a new account today and receive 100 free trades. Visit www.sogotrade.com to learn more about all our free trading tools, educational resources, and other resources available to you to enhance your trading experience. Remember, options involve risk and are not suitable for all investors. For more information, please read the characteristics and risks of standardized options available at www.sogotrade.com. Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.